It's good to have you join us. Thanks for giving us your time. I'm Felicity Ezewike. Let's begin by telling you that the Central Bank of Nigeria has raised the monetary policy rate by 50 basis points from 26.25% to 26.75% in response to soaring inflation and skyrocketing food prices. CBN Governor Olayemi Cardoso announced the increase on Tuesday during the Apex Bank's 296th Monetary Policy Committee meeting in Abuja. The MPC also set the cash reserve ratio for deposit money banks at 45%, while mattered banks will see their CRR adjusted to 14%. The liquidity ratio has also been set at 30%. The MPC meeting is convened to assess the country's economic and financial conditions and to determine the appropriate monetary policy direction for the short to medium term.
Decisions are as follows. Raise the MPR by 50 basis points to 26.75% from 26.25%. From 26.75% from 26.25%. Adjusted the asymmetric corridor around the MPR from plus 100 to minus 300 to plus 500 to 100 basis points. Retain the cash reserve ratio of deposit money banks at 45% and merchant banks at 14%, and retain the liquidity ratio at 30%. Okay, ultimately, if we're doing all the things we're doing and we're not able to impact the man on the street, ultimately, then what do we really say we've been doing? And I think sometimes when people look at figures too often, they may lose track of that. And that is why I said what I said, that it is so important that we continue to bear that in mind, that our policies must ultimately impact the man on the street.
To discuss this, I'm joined by Chartered Accountant Aki Fatunke. Aki, good evening. Thank you, as always, for joining us. How might the increase in NPR from 26.25% to 26.75% impact borrowing costs for businesses and consumers in Nigeria?
Thank you very much, Felicity, for having me, and good evening, Nigerians. Clearly, the 50 basis points within the asymmetric corridor, 100, 300, naturally will lead to higher borrowing for businesses, and that includes the SMEs, and then you and I, consumers. Why is this? Because typically when the MPR is raised, it measures the benchmark by which the commercial banks borrow from central bank. And because they want to maintain their profit margin, actually, lending rates will have to go up. Now, the higher interest rates on loans naturally will also have to go up, and this will reduce borrowing and investment. It will increase cost of production for businesses and SMEs. It will lead to higher prices for you and I, being the consumers, and of course, overall, slow economic growth.
With the liquidity ratio now pegged at 30%, how do you foresee this affecting lending activities and overall economic growth in the country?
If lending is not going to increase by way of quantum, you are going to have a lot of competitiveness. Businesses struggling to try and stay within those loans. The available loans that you have. And what that does, that's steep competitiveness, because it's just 50 basis points. Now raise what I'll call the lending rates. Also will have to, not help, the demand on the streets so very well. So the demand side, okay, to try to tame inflation will naturally come down. But if this is not met on the other side with productivity increase in food production, the inflation will still continue to run very, very high, especially the urban, the headline, not to talk about the food inflation that is over 40%. So that 30% will help to try and pull in perhaps liquidity that is a bit outside the system, that is been very hard and difficult to tame up till about now. But that's all that will do.
Given the current economic conditions, do you think these policy measures are sufficient to address inflationary pressures and stabilize the economy?
It cannot be. It cannot even be sufficient. And the CBN governor was clear that if all the things that they are doing is not touching the man out there on the street, then what exactly, like you say, what exactly are we doing? So there has to be the proper clap from the monetary, and also a proper clap from the physical. We need to see more happening. And given the fragile economy that we have, a couple of things that just happened within the last 2 months, like we know, minimum wage after a lot of drag here and there, has not really taken up. We need some extra budgetary to making sure that the federal as well as the states meet up, and they must meet up, even though we are not meeting up with what you call the living wage. And so, okay, the fragile nature, galloping inflation, okay, we have to tame the demand side, but we need to begin to look at the supply side. The additional measures that I will recommend will be fiscal policy adjustments. I mean, there have to be reduced government spending. When I say reduced government spending, we may have to find ourselves spending on the real people, the people on the streets that Mr. Cardoso is talking about. But for government and for apparatchiks of government, they have to go beyond what the National Assembly, I think the House of Reps, is talking about reducing for 6 months their basic salary. It has to cut down the line, federal, even up to the states. Now they are getting more money. Can we begin to see that some of these monies are now applied to helping to boost the economy? The poorest of the poor, we need to. Now we need to also look at the exchange rate management, and we have to do structural reforms to improve the business environment, really, and able to attract investments as much as we can, even though many are flying out with their feet.
Basically, a lot more work is required.
A lot more work other than talk is required, and we must begin to see more of this movement on the physical side. Yeah.
All right. Thank you, as always, for speaking with us.
Always a pleasure, Felicity. Thanks for having me.
Yeah. Have a good night.